In this video, we're going to explain the 5 different types of investor or fully managed investment portfolios might be suitable for. Don't worry if you're not sure, as our online assessment identifies which type of investor you look like based on some simple multiple choice questions. A defensive investor is mainly concerned with volatility. The amount an investment goes up and down in value, which could mean they are willing to accept lower long-term returns in exchange for smaller and less frequent changes in portfolio value in the short term. Safety for their investment is the priority. They don't want to see short-term losses, so they are willing to accept smaller long-term gains, on the understanding that they'll have more stability in the value of their investment. A cautious investor is the next step along from a defensive investor. Protecting against short-term volatility rather than maximizing for long-term growth is still the main concern, albeit to a slightly lesser extent. On the scale of risk and reward, a cautious investor may tolerate a little more price fluctuation than a defensive investor, thus seeing more potential opportunities for growth in the long term. On the defensive to aggressive scale, balance sits in the middle. Reducing volatility and maximizing returns are typically of equal importance to the imbalanced investor. Still, the balanced investor is still concerned with short-term losses and may shift to a more stable option in the event of significant volatility. A growth investor may be willing to accept higher risk and the chance of increased volatility in order to achieve higher returns on their investment. Significant fluctuations over an extended period may prompt the growth investor to shift to a less risky investment, but on the whole, focus is on the potential growth, which could come with holding on to this investment long term. The aggressive investor is most concerned about long-term expected returns. Minimizing possible volatility isn't the main goal, which means the aggressive investor can tolerate both large and frequent fluctuations. In exchange for accepting fluctuations in the short term, the aggressive investor aims to achieve higher return over the long term. On the scale of risk and reward, the more risk is taken for the potential of more reward. When reflecting on these 5 risk profiles, remember there is no right or wrong type of investor, and we have all 5 types on True Potential Investor. Take our online assessment today to find out what type of investor you are.